Imagine waking up to a market that feels like it's unraveling right in front of your eyes. Gold futures gap down by $60 in less than 48 hours. Silver plunges over 4%, and the gold-silver ratio spikes to levels not seen in years. Traders are liquidating positions frantically. Hedge funds are hitting margin calls, and the shadow banking system, the hidden layer of leveraged credit behind the scenes, is straining under unprecedented pressure. This isn't a normal pullback or a routine correction. This is a structural shock, where the plumbing of global finance is colliding with precious metals markets, creating an environment of extreme uncertainty. Analysts are predicting rallies based on inflation or Fed policy, but the reality is far more complex. What we are seeing is the convergence of forced liquidation, leveraged paper markets, and tightening physical supply. When paper shorts are dumped into an already fragile market, prices can fall rapidly, even as real-world demand for physical metal tightens. The tension between paper and physical gold and silver is creating a scenario that few are prepared to analyze, and it could rewrite market behavior for months to come. This crisis affects far more than just traders staring at screens. Retirement accounts, pension funds, and sovereign wealth portfolios are all exposed to the same derivatives and futures contracts that are being liquidated. The ripple effect reaches small businesses, supply chains, and everyday investors who think gold and silver are safe havens. When leveraged positions unwind violently, liquidity dries up, credit spreads widen, and the cost of capital spikes across sectors. Even large corporations relying on short-term borrowing or trade finance can find themselves suddenly constrained, creating operational stress and forcing cost-cutting measures. The stakes are global. An unexpected market collapse in shadow banking could force central banks to intervene, alter monetary policy unexpectedly, and destabilize currency markets. Ordinary people might feel this in the form of higher prices for basic goods, tighter credit, or sudden volatility in their investment accounts. It's a structural story that moves beyond metals. It's about the interconnectedness of global finance, and how quickly risks in one segment can cascade across the entire system. The trigger came with a sudden spike in margin calls across leveraged funds and commodity traders. Gold dropped from $2,205 to $2,146. Silver from $27.80 to below $26.70, and open interest on COMEX contracts fell sharply. Hedge funds and commodity trading advisors were forced to liquidate positions to meet obligations, creating a waterfall effect across paper markets. Simultaneously, physical premiums in Asia surged, with spreads hitting $35 to $55 over spot, signaling that demand in the real market was tightening even as paper markets were bleeding. It was a classic liquidity squeeze. Paper markets collapsed first because they are the most leveraged, while physical demand continued to strengthen quietly behind the scenes. This sudden divergence is confusing for many investors, who see falling futures prices and assume physical demand is weak, when in reality the opposite is happening. It's a subtle but critical nuance that will dictate how markets move over the next several weeks. At the core of this upheaval is a structural imbalance between paper and physical markets, amplified by shadow banking leverage. Large speculators have been long gold and silver for months, creating a precarious buildup of risk. When forced liquidation began, the positions unwound violently, sending futures prices sharply lower. Meanwhile, central banks and large institutional buyers continued to accumulate physical metal, further tightening real-world supply. The divergence between futures selling and physical accumulation is widening, creating conditions for either a sharp bounce or continued collapse. Shadow banking exposure adds another layer. Leveraged credit lines, repo transactions, and derivative positions create systemic interconnections that can amplify market shocks. This is not a simple story of supply and demand. It's a complex interaction of leverage, liquidity, and structural risk, and it explains why conventional gold and silver predictions are failing to capture the current reality. The human and business impact of these moves is already visible. Hedge fund managers face forced exits, traders see margin calls wipe out months of gains, and commodity brokers scramble to manage risk. Businesses that rely on metal-based inputs or financing suddenly face cost spikes or liquidity constraints. Even ordinary investors can feel the pinch. ETFs tracking metals decline sharply, retirement accounts take unexpected hits, and consumer confidence can be undermined as volatility spreads into other asset classes. Small manufacturers who hedge commodity costs may be forced to raise prices or delay production. The knock-on effect of shadow banking stress is rarely visible immediately, but it quickly filters into real economic pain, impacting employment, borrowing costs, and market confidence in ways that are often underappreciated by mainstream commentary. Compounding the crisis, global credit conditions are tightening just as inflation remains sticky. Repo rates and credit default swaps are showing stress signals, and the cost of borrowing in some segments of the shadow banking system is spiking. These pressures create a feedback loop. Forced liquidations depress prices, which triggers further margin calls and credit tightening. It's a self-reinforcing cycle that could continue until liquidity stress is alleviated, either through institutional intervention or market-driven consolidation. Investors need to understand that this is not a temporary hiccup. These dynamics can persist for weeks or months, creating volatility and risk that few are pricing in. The interconnections between metals, credit, and leverage make this a uniquely dangerous environment for both paper and physical markets. A second compounding factor is the divergence between U.S. policy expectations and global monetary realities. While the Fed signals rate cuts, global inflation pressures in Europe, Asia, and emerging markets remain elevated, forcing central banks elsewhere to maintain tighter conditions. Currency instability in countries like Turkey and Argentina drives sovereign demand for gold, adding physical pressure even as U.S. paper markets collapse. Supply chains remain constrained, with mining output insufficient to meet rising demand, particularly for silver. This combination of credit stress, divergent central bank policies, and physical market tightness creates the conditions for unpredictable and amplified market moves. Investors should expect sharp swings, potential liquidity dry-ups, and unusual pricing relationships as these forces interact. The national impact is significant because shadow banking exposure touches multiple layers of the domestic economy. Large commercial banks, hedge funds, corporate treasuries, and municipal finance vehicles all rely on short-term credit markets that are intertwined with shadow banking. A liquidity squeeze could force these institutions to reduce lending, tighten balance sheets, and constrain investment across sectors. Consumer credit costs may rise, businesses may delay expansion, and even well-capitalized firms could face operational stress. In essence, a local failure in shadow banking can cascade nationally, affecting not just traders and speculators, but also everyday Americans through higher borrowing costs, reduced credit availability, and broader economic uncertainty. Gold and silver are indicators here, signaling stress before it spreads fully into the economy. The final warning is that this is a structural shift, not a temporary market hiccup. The divergence between paper and physical markets, the leverage in shadow banking, and the stresses in global liquidity are creating conditions unlike anything in recent cycles. Investors need to recognize that traditional indicators may fail, and that the next move could be sudden and extreme. Whether prices collapse further to $2,050 in gold and $25 in silver, or surge as physical shortages force a squeeze, the critical takeaway is that the system is fragile. Independent analysis, careful monitoring of physical premiums, open interest, and credit indicators will be essential. The story of this crisis is one of hidden risk, structural imbalances, and the need for disciplined observation. Because in volatile environments like this, assumptions can be dangerous, and the market can change in hours rather than days.